3 minutes, Mr. Doggett.
Thank you, Mr. Chairman. While sincerely applauding your personal commitment to right our economy, I continue to have the same concerns about the effectiveness of the bailout and its fairness to taxpayers. As of this morning, are you personally aware of any federal employee at any relevant federal regulatory entity that has been who's been fired or demoted or disciplined in any way as a result of this debacle? And since Congress approved this $700 billion bailout, are you personally aware of any request that has been made to anyone in the private sector responsible, whether they're on Wall Street or somewhere else, for this debacle, that they be replaced or just asked to take a pay cut?
Well, on Wall Street, there have been quite a few high-profile firings of CEOs based on their performance in the recent period.
Since the bailout?
The bailout was, the capital injection was only last week. But there,
well, I'm talking about since it was signed into law, there really haven't been any requests that Treasury has made that any of those people be replaced, have they?
So the Treasury's approach is twofold. First, we want to strengthen our financial system so that the counterparties who deal with our banks will not be worried about their insolvency and will be willing to deal with them.
Sure, I understand there may be a rationale for taking that course, but I just want to make it clear that there has been no removal of anyone from any federal regulatory agency or discipline or any request that anyone, since the bailout was signed into law, be removed or asked not to take even a bonus on Wall Street.
If the Treasury undertakes to deal with a mismanaged bank that is close to failure, then its terms will be much more draconian and tough than the case where we're just trying to broaden the base of capital throughout our economy. In the case of the Federal Reserve, I would mention that when we made this large loan to AIG Insurance,
yes, sir, that was before the bailout, and you did take some action there, but that has not been copied since then. How about just a request that the individuals not be rewarded with a bonus this year? When, as you know, when Deutsche Bank CEO and many of its leading traders have pledged that they'll waive millions in annual payouts, there's a recent report that 6 major U.S. banks have reserved a total of $70 billion for pay and bonuses this year, a substantial portion of which represents discretionary year-end bonuses. Isn't the American taxpayer in this bailout just being asked to subsidize those executive compensation schemes and maintaining dividend payments? And indeed, since the bailout bill, in the short period you described, hasn't Treasury actually weakened what I viewed as political pablum in the original bailout bill on golden parachutes by saying that you don't define a golden parachute as anything that's a mere 3 times normal pay and bonuses?
Well, Congressman, my understanding, and you can follow up with Treasury, my understanding is that all of the provisions that Congress inserted with respect to executive compensation have been applied to every recipient of capital, which was not required by the bill. So there have been applications of what was in the bill. I don't think the Treasury has authority beyond what Congress gave it to insist on other restrictions.
It did define a golden parachute as 3 times anything these banks want to pay their executives, didn't it?
Yes.
Thank you. Mr. Chairman, I don't believe it's reasonable to launch a large new expenditure without considering how the last $700 billion that Congress approved is being used. With nobody taking personal responsibility for any part of this financial system fiasco, either in Washington or on Wall Street, and with some of the people who contributed to the crisis actually getting rewards instead of penalties, we don't have a formula for preventing a reoccurrence of these excesses. Going forward, we have essentially the same federal regulatory personnel, the same Wall Street directors, the same executives running the same show as they were running before the Bush administration made its urgent plea of bailout or bust. And I believe the American people would be better served by our seeking more accountability, more transparency, and a better return on their investment. While I'm very pleased that direct investment in banks, an approach that so very recently Secretary Paulson was in this Congress condemning as what he called an admission of failure, that was used as the first choice of the Treasury I don't believe that there is adequate public understanding of the terms of that investment. Treasury acted not as the lender of last resort, but as the lender of best resort, offering banks a far sweeter deal than the terms Warren Buffett required, a far sweeter deal than the British banks got. Indeed, about the only similarity with the Buffett deal and the Treasury deal is the name applied to the stock, which in Treasury's purchase amounts to essentially a below-market 5% loan. Mr. Buffett got twice as much in dividends as taxpayers are to receive, and he got more than 85% more common stock rights than taxpayers will get. And now, according to Chairman Bernanke's speech last week in New York, the Treasury will return to the purchase of toxic securities, what Nobel Prize-winning economist Joseph Stiglitz has called the cash for trash plan. Most folks seeing so much money being spent now out of the $700 billion have good reason to wonder how much of it will be available when the new president is sworn in January. And all of this comes with an understanding, I think, by everyone that this $700 billion is not about stimulating our economy out of the current economic recession. It's only the necessary and expensive medicine for preventing a financial system shutdown.